And Larry, you're feeling the data. You're not so lonely anymore, though. More people are coming around to your view that they shouldn't hike.
No, I've been of that view for a while. Again, I think the Fed should be data dependent. The data is coming in to show that it would not fulfill their mission if they hike tomorrow.
You're looking at the data on it. So, Larry, I think this is really important. There's one camp who thinks because we have a slowdown in a market sell-off, the Fed shouldn't hike. Your point of view is, no, the economy's fine. There's just no inflation, so they shouldn't hike.
Absolutely. The Fed should not raise rates because GDP is growing too fast or because too many people are working. What they need to do is look at inflation. Last 3 quarters, their preferred measure of inflation, PCE deflator, has declined quarter after quarter after quarter, and it's likely to be lower in the 4th quarter as well. Core PCE is at 1.5. Market-based PCE, both headline and core, are at 1.4. We're now below 2, which used to be the Fed's target, and dropping. That is a sign they shouldn't be hiking.
Yeah, even though, again, it's not that Trump's pushing them around. It's not that the market's pushing them around. Just on the inflation data themselves, even if the economy's strong, you're saying they shouldn't hike. That's a weird situation to be in. We noticed this morning now the Wall Street Journal op-ed page, which is typically more of a hard money kind of shop, is saying they agree that the Fed shouldn't hike. But this is an organization that's like the Titanic. They can't just decide today, you know what, they're right. They have to signal. They have to come to a consensus about this. This is the first of a 2-day meeting. Have all of those things been put in place, you think, to really take a hike off the table?
Well, back in the old days, when I was a Fed governor, we didn't even issue a statement at the end of the meeting. So I'm not sure what we have to prepare the markets for. I think Keynes said it right, Kelly. He said, when the facts change, I change my mind. What do you do, sir? And frankly, the facts have changed since the September and even since the November meetings. We're getting more verification of declining inflation. And something about the labor market people don't understand. The labor market right now is disinflationary. What economists call the marginal revenue product, which is how much people produce plus how much more they can sell it for. It's basically inflation plus productivity, is running around 3.8. Wages are running at 3.1. Whenever wages are running faster than the marginal revenue, slower than the marginal revenue product, we are in disinflation, not inflation from the labor market.
So, Larry,
again, another reason not to hike.
Larry, you say that you have faith in the rationality of the Fed and that they will come to their senses and not raise interest rates tomorrow, and that yet there are lots of other people who see them as, quote, crazy in the face of data and in the face of things out there. How crazy, really crazy, is a quarter-point interest rate hike? How meaningful would that be in terms of its impact on the economy?
Well, first of all, you're correct. A quarter point here, a quarter point there doesn't matter. What matters, though, is the Fed's credibility. And if they raise tomorrow, they will be saying, we're ignoring the data. They'll be saying that, our mission is to carry through with what we said 3 months ago rather than look at the facts on the ground. I don't think that's something that they really should be doing at this point.
But something else has come into the picture since that, Larry, and that is the president, who has very vocally been putting his thumb on the scale in favor of not raising interest rates. And so doesn't that have if they failed to raise interest rates, wouldn't that call into question their credibility in the face of the presidential pressure?
Well, first of all, just because Trump says something doesn't mean it's necessarily false. Even a stop clock is right twice a day. And as for credibility, one might remember that
I'm not saying he's right or wrong.
I'm
not saying he's right or wrong there. I'm not taking a side on that. But I am saying that when the president comes in and pushes a nominally independent agency to do something, and then that agency, which has sort of put stakes in the ground saying we're going to do this, and then folds, that would call into question their credibility. I'm not saying that the president isn't right about this.
I don't think so at all, Tyler. Did Janet Yellen squander the Fed's credibility in 2016 when she committed to raise 4 times and then didn't raise till after the election? I didn't hear you saying it then, right? So again, we have to take things calmly here. The Fed should not raise. I think they will not raise for all the right reasons. As for the president, sure, the president's probably better advised not to do that. But we all know where the president's coming from, right? A, he's the incumbent, and B, he grew up as a real estate developer. So I don't think there's a lot of value added in the president's comments.
Larry, think
and I don't think the Fed is going to take him into.
You were saying that before you go, that you think the Fed will be raising in 2020, and he's really not going to like that.
Right. I mean, look, I happen to agree with what Chairman Powell said the first time, which was we are a significant distance from where long-run rates should be. But long run is long run. And you get there, when you can, when the data supports you. I think 3 to 3.5 is the long-run Fed funds rate. But if they make a mistake tomorrow, what the market is telling them, they'll never get there.
Yeah.
The market is now telling them if they raise tomorrow, no hikes in 2019 and cuts in 2020, right? That should be a signal that you shouldn't do it.